Okie dokie. Okie dokie, everyone. Can I start off by saying either a good morning, good afternoon, or even a good evening, depending on where you are around the world? And welcome and thank you for joining me tonight on the latest episode of How I Trading Series for Stratton Markets. Now, tonight's episode is called How I Got to Understand Breakouts Part 1. Written by myself, which is James Truskothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, before we get on to agenda or an introduction on myself, of course, we're talking about online trading and CFD trading. And like with any type of investment, it does indeed carry a great deal of risk. So I do suggest you do your own due diligence and do your own research. And, of course, know of the risks at hand before entering any trade. Now, with that out the way, this hairy, plump individual is me. Like I say, my name is James Truskothick, and I'm the Chief Trading Educator here at Stratton Markets. Now, I've been in the financial service industry for over 20 years. I actually started off as a mortgage broker before moving into pensions and then alternative investments before getting involved in trading. I've traded through several product companies myself, ran a room at the Philippine Stock Exchange before heading into portfolio management, and then later down the line, education. Daisy, wrong button. I'm also a published writer, and I've been published in several leading industry publications. A little sip of coffee, such as the Financial Times Advisor, Market Watch, The Street, and several newspapers and magazines. I'm an avid market commentator. I'm very passionate about this marketplace, very passionate about the markets, and I'm a well-known public speaker. And I've spoken at a number of events around the world, including the likes of Singapore, Dubai, Kuwait, Qatar, South Africa, more recently, London. Obviously, as you can tell, I'm a Brit. Berlin. Let's name a few off the top of my head. Now, tonight's agenda is only part one, and we're going to discuss, wrong animation. First of all, what are breakouts, and then spotting trading opportunities. And then obviously we'll talk about future educational events. Like I said, this is only part one, so it's a short episode, this one. So what are breakouts? A breakout is when an asset breaks through a key level when it's have either been ranging or consolidating. Now, traders look out for breakouts so they can enter the market and ride the volatility. So they're looking at breakouts for potential market opportunities. Now, this is how breakout looks like. Okay, so you see a market is going up, down, up, down, up, down, up, down. Okay, so basically it's ranging between two levels. You know, if I can get my little color pen. Is a pen? Yeah. So obviously it's ranging between the resistance and support. What traders are looking for is when this happens, a breakout of that key level. Because then when they're looking for that, they're looking to jump into the market to then ride the volatility. Because at this point, the market's sort of taking a breather. It's having a little bit of a, little bit of a rest. They're not making any mass decisions. So volatility is quite narrow. So when they're looking for a breakout, volatility increases. And this is what traders look for because this indicates a potential trading opportunity. Excuse me. Now, there are two main types of breakouts. Continuation breakouts, excuse me, and reversal breakouts. A continuation breakout, this is when an asset is basically heading in a set direction. But then the market takes a little bit of a break, has a little bit of a breather before the trend continues. And it looks a little bit like this. Now, this is the euro dollar on a 1 hour chart. Now, as we can see, the market reacted quite volatile and pushed the market down further or pushed the euro lower. Then the market had a little bit of a break and it then range trade for the next good couple of sessions until, of course, we had the breakout and it then pushed further lower. And this is where the trader is looking for, is this breakout, so then they could potentially jump into the market. Here's another example. This is the British pound US dollar, again on 1 hour. So again, the pound, bullish, well, it was bullish at the time, against the US dollar. Okay, a big, nice little bull run. Then the market took a breather, it range trade before continuing the trend. And this is when what the traders look out for, this breakout, and then they jump on it and they ride the volatility train. Now, there's another type of breakout, and this is called reversal breakouts. Now, reversal breakouts start really much the same way as a continuation breakout. But when the pause happens, instead of continuing, it actually reverses that trend. And here's some examples. So here we go. We've got the gold on a daily. So as we can see, gold on a daily, market under pressure, or gold under pressure, bearish market pushing gold lower. Then the market has a little breather. It takes a break. It has a little bit of a break, and it range trades between those two levels until it then reverses the trend altogether, breaks through that level, and it reverses and goes up higher. So again, a trader is looking for this breakout period and going, right, no, it's not continuing, it's reversing. Let me now jump in and ride the volatility train. Here's another example. This is the dollar Japanese yen, again on a daily. So the market is pushing up higher. Then it has a breather, has a bit of a break, has a little bit of a sleep, a little bit of rest, and it range trades until we then see a reverse. It breaks through that level, falls down lower, going lower, and it reverses the trend. So again, a trader is looking for a breakout of these levels when it's having a little bit of a breather. Now, there's a couple of methods of trading on a breakout, how you trade it. Okay. Now, one is quite aggressive. One is known as the aggressive break. And basically what the trader then looks for is when a level is broken, first of all, you need to be able to recognize the support and resistance when the market is having a bit of a breather, when it's range trading, when it's having a bit of a break. You need to be able to recognize the support and resistance during this time, and you need to recognize those levels. I mean, it's quite easy. If you go back on this previous chart here, for example, you know, we can see that it's been trading ching, ching, ching between those levels. We recognize where the support is and where the resistance is. So when we're looking to trade the breakout, what we're looking for, and this is the aggressive feature, is once you see that level broken, then people then jump in, setting their stop loss. Some people who are aggressive jump in, setting their stop loss slightly above where that level was. So that's more the aggressive break. The other alternative, of course, is more of the cautious approach. And with this, what they do, the cautious approach is they wait for the level to be broken, but they don't jump in. They jump in to see if indeed that level is broken, and that level is switched its roles. Do you know the rule? You know, if resistance is broken, it then sometimes becomes a support. If a support level is broken, it then sometimes becomes a resistance. So the cautious people, or the cautious traders who jump in with the break on a breakout, they wait to see indeed if that level has changed its roles and become a resistance. So they wait for it to see it come back, break it, then come back to test it. And if indeed it then holds as a resistance, that's, or indeed swapped its roles, that's when they enter, setting their stop loss slightly tight just above that level where it's now, you know, changed its roles. Up and coming educational events, we've got on the 22nd of January is how I learned about the different time frames, which is very useful. Certainly if you want to know what type of trader you are, scalper, swing, or position trader, that's on the 22nd of January. It's how I learned about the different time frames. Then on the 29th of January, we have how I got to understand stock CFDs. And then, of course, we have the February schedule. If you wish to speak to me, feel free to email me at james@strattonmarkets.com, or indeed you can follow me on my Twitter account, which is @jtruskothic. And of course, you can then also direct message me on that. So if you have any questions or you wish to reach out to me, DM me on my Twitter or email me at james@strattonmarkets.com. Before I sign off, of course, we've been talking about online trading and CFD trading, and like with every type of investments, it does indeed carry a great deal of risk. So I do suggest you do your own research and your own due diligence and know the risks at hand before entering any trade. So till next time, can I wish every single one of you either a good morning, good afternoon, or good evening, depending on where you are around the world. Till next time, every single one of you, trade safe.